Welcome to the Nedgroup Investments Excess Diversified Fund of Fund Quarter 3 Fund Commentary. The Excess Diversified Fund of Fund sits in the multi-asset class high equity prudential category. Its return objective is inflation plus 5 over a rolling 5-year time horizon, and it is allowed a maximum of 75% in equities. If we look at the fund's performance contribution over the last quarter, we see that most of the return within the fund came from the global equity space. Global equities provided the fund with approximately 1.3% or so of positive contribution for the quarter. This is in relation to the fund achieving a total return of 1.5% versus the peer group of 1.1% over the quarter. Most of the contribution from the global equity side came about as a result of extreme rand weakness over the quarter. The other area that helped the fund was our exposure to domestic fixed income and cash holdings that are currently achieving returns of around about between 8 to 9% per annum. Areas of the portfolio that came under pressure was both domestic property as well as locally listed South African small cap stocks. Both of these areas came under pressure due to the South African economy weakening even further and falling into a technical recession. Looking at fund performance, we see over the fund's recommended time horizon of 5 years that the fund has achieved a return of 7.6% relative to the peer group of 6.7%. Looking at the calendar year performance, you will notice that barring 2017, the fund has quite comfortably managed to outperform peer groups across every calendar year. The fund is currently sitting in the second quartile of the fund rankings within the multi-asset high equity prudential category. Looking at risk measures within the fund, we notice quite a few interesting characteristics. First of all, the fund has had a volatility of approximately 7.3% versus the South African equity market of 14.6%. The fund has had a maximum drawdown of minus 15% versus the South African equity market of minus 40.4%. And 67% of the time, the fund has achieved a positive monthly return. If we look at the rolling 5-year return graph on the left-hand side, you will notice that the fund has achieved outperformance over its peer groups 100% of the time. Looking at the quarterly return distribution graph on the right-hand side, we see that the fund has achieved the vast majority of the time performance somewhere between minus 2% and plus 5% on a quarterly basis, with the vast majority of returns being somewhere between positive 2 and positive 5%. The following table just sets out the performances across the fund for the various asset classes that one can invest into, if one finds the appropriate asset class to assess the performance of the particular fund that you are invested in. Looking at asset allocation changes within the fund, we notice, two main things have changed over the last quarter. First of all, over the quarter, we reduced our offshore exposure via direct holdings. This was done when the rand weakened extensively to approximately 15 Rand 30 to the dollar, and we decided to bring some of those offshore assets back into South Africa. You will notice that global equities, for example, has reduced from 21.8% to 17.1% over the last quarter, whereas our South African equity exposure has gone up, as has our domestic bond and domestic cash asset classes. We feel that the South African market is showing signs of better value now, and we have slowly been nibbling into the South African stock market as asset class prices have shown better value and some of the stocks have re-rated downwards. Looking at the asset allocation of the fund, we will see that the fund has 25.5% in direct foreign holdings and a further 22.8% in Rand hedge stocks. Rand hedge stocks are defined as those stocks who earn at least 50% of their revenue from offshore. You will notice that several of our large top 10 holdings are Rand hedge stocks such as Naspers, Sasol, British American Tobacco, BHP and Richemont. Looking at our fund's asset allocation positioning, you will notice that we have increased our South African equity exposure and are now still sitting slightly underweight but much more closer to a neutral position. From property and bond perspective, we have been increasing our exposures here and we are now close to a slight overweight position across these asset classes, including cash that we hold in an overweight position, waiting to deploy for further market opportunities. On the offshore side, we have reduced our global equity exposure and are now currently sitting in about a neutral position, and we are underweight in terms of global bonds and global property. We are also sitting in a slight overweight position from a cash perspective, waiting for opportunities to reinvest. In terms of our underlying fund managers that we use, you will see we have set this out on the last slide, and we have a range of some of the leading both South African and offshore managers managing various parts of the portfolio. This is one of the benefits of a multi-manager fund, where you can get exposure to different fund manager styles that will perform differently during different market cycles. We hope that you find this fund commentary and report useful and insightful. Thank you.